and welcome to the Global View on this Tuesday. I'm Andrew Gay. Good to have you with us here at Ausbiz. So let's get to what happened overnight. Now, markets in the US, Canada and Brazil were closed for holidays there, while much of Asia also on holidays for the Lunar New Year. In Europe, the Stoxx 600 index edged higher to begin the week as financial shares rallied, while investors were focused on a busy week of corporate earnings that could shed light on the health of corporate Europe. A rebound in the banks offset weakness in tech stocks. Shares of French software company Dassault Systems fell heavily on concerns over the company's ambitious revenue and cloud targets. In London, the FTSE 100 ended higher, defence stocks rallying, following a report that the British government is considering bringing forward its target to spend 3% of GDP on defence. British banks NatWest and Barclays led the broader sector higher, tracking a recovery in European financial stocks. British banks suffered their biggest weekly fall in almost a year on Friday as investors reacted to the disruptive threat of AI models. Well, in the latest economic data, Eurozone industrial production in December fell 1.4%, which was slightly better than forecast. And the latest Bank of America fund manager survey showed positioning in the US dollar was the most negative in the survey's 14-year history. US dollar index down around 15% from its peak in 2022, with consensus expectations of further weakness in the year ahead. Well, the US dollar index up slightly on the day. The Aussie is currently trading at 70.7 US cents. The US Treasury physical market was closed, but futures trading implying the 10-year yield fell to 4.03%. Australian 3-year government bond yields, they fell to 4.26%. The 10-year at around 4.73%. In commodities, oil prices edging higher as investors consider the implications of planned talks between the US and Iran and expected OPEC Plus supply increases. Brent crude futures rising more than 1% above $68 a barrel. Gold has fallen more than 1% amid light holiday trading. Spot gold is close to $4,990 an ounce. Copper down 1%. Iron ore little changed at $99 a tonne. And Bitcoin currently trading around $68,500 US. Well, earlier I caught up with Mugunthan Siva from India Avenue Investment Management to break down market sentiment following a relatively stagnant year in India, with the management firm coming out with their quarterly report.
Since the peak in September 24, we're basically around similar levels, slightly down from there. I guess the key factor has been other markets have moved on in 2025, like Korea, Taiwan, China, some of the other emerging markets. And India has been in a standstill after 4 years of strong numbers. The Australian dollar certainly hasn't helped in terms of any international investments, and the rupee has also been weak. So those things have compounded together to make India not such an attractive investment in the calendar year of 2025.
All right, let's now look. I mean, a lot of volatility there. In particular, there's US-India trade relations. Has that been resolved?
Yes, in principle, but there's still a lot of the fine print to come. So there was a deal announced between the two countries without the fine print, with just headlines. Right now, it looks like India's tariffs have gone from 25% to 18%, and they've removed the additional 25% tariff for buying Russian oil. Essentially, we're not quite sure who's got the best of the deal, but for India, looking to grow its export markets from 825 billion in 2025 towards 2 trillion by the end of the decade, this is essential, along with the European deal that happened the week before.
Yeah, that's obviously also critical there, and part of the US deal being that they've got to stop buying Russian oil, essentially, isn't they? So is that happening?
Yeah, so the ideal scenario for, I suppose, the Trump administration would be India buys oil through them from Venezuela rather than buying Russian oil. If that does happen, then India will have to negotiate with the price that it pays, but hopefully it won't be too much more than what they're paying right now.
Mugunthan, what's going on with, more globally, we're seeing the AI trade, a lot of volatility there, of course, particularly those SaaS-related stocks that have been hit hard. How's that playing out in India?
Yeah, so the Indian IT firms have also been hit quite dramatically in the month of February. And India didn't really participate in the AI upside because it doesn't have that exposure of innovation in that space like Korea or a Taiwan or a China would have. So yeah, it certainly did have an impact on the broader stock market because Indian IT services firms are about 10% of the market cap.
All right, and what are you seeing in terms of those foreign inflows and outflows at the moment?
So foreign inflows still remain negative. They have, however, started to consolidate at these levels. We've seen a lot of positive action in terms of rate cuts, focus on consumption, reforms, particularly when it comes to labour, which are positive for foreign investors longer term. These trade deals also will allow India to grow its exports and therefore GDP growth. We've seen multiple investments from Google, Amazon, Microsoft to the tune of up to 70 billion. All these things should at some point lead foreign investors back towards being interested in India, particularly when the currency is a little bit weaker than it has been. So it provides a more favourable entry point than where we were 12 to 18 months ago.
What are those currency movements doing, particularly, I guess, for those Australian investor returns in India?
So the first half of 2025 was more about rupee depreciation because the trade deals weren't getting executed. There were some concerns from a geopolitical front. Foreign investors were withdrawing money from markets in particular. The second half of 25 and into 26 has been much more about the Australian dollar. The rupee hasn't necessarily lost ground against the US dollar, but the Aussie has been all conquering with commodities and rate rises.
So let's look at positioning then in Indian stocks. So what are your advisors looking at the moment in terms of perhaps favouring the large caps over more sensitive smaller caps?
Yeah, so very much in 25 the thematic was towards consumption because they were reducing GST, they were reducing tax rates, they were cutting rates. So the focus was towards credit growth and industries that would benefit from that. So be it financials, be it non-bank financials, be it automobile companies or two-wheeler, those were the stocks that were seeing strong sales and earnings growth. In 2026 and onwards, there is starting to become a discussion around mid and small caps are best placed to benefit from leverage of this export and trade. Areas like textiles, gems, auto ancillaries, specialty chemicals, pharmaceuticals we've talked about many times, which will benefit from India becoming a more integrated player in global supply chains.
And talking sectors, you're liking the financials at the moment?
Yeah, we're overweight financials. We've came from underweight at the beginning of 25 to an overweight position today, and we keep increasing that because that is the easiest way to play the consumption story. And we still remain overweight pharmaceuticals because we feel that's the next structural trade that will continue to play out.
Just in terms of finance stocks, I see you in particular looking at Shriram Finance?
Shriram Finance is a non-bank financial company. It's essentially a lender to finance second-hand cars. One might think, that's an old school type of business. So car ownership in India is still only at 4 to 5%. There's a lot of second-hand trade that occurs. And recently we had a Japanese company take a 20% stake in this business, so injecting significant capital which will allow them to grow their loan book.
Mugunthan Siva from India Avenue Investment Management. Let's now turn our attention to the open locally and taking a look at ASX SPI futures up around 0.1%. Now clearly the focus is going to be on more corporate results today, in particular BHP out this morning. We'll get some analysis of that, many more results to get to, plus we'll get the minutes from the RBA's last meeting where of course they lifted rates. So perhaps some further explanation as to why and what they see ahead. Stay with us. The Open, just a couple of minutes away.